Investors of popular funds are paying up to 3 times more than the ticketed prices once the additional fees are added, according to new research. The ongoing charges figure, known as OCF, has long been the industry's standard measure of running costs. But the trouble is, it was unclear exactly how much investors were being charged paying in transaction, also known as trading costs, as well as other one-off fees. In short, these charges aren't new, but they must now be declared by fund managers. A by asset management consultancy firm The Lancat found that transaction fees charged by some popular UK funds are almost double the OCF. The Janus Henderson UK Absolute Return Fund has an OCF of 1.06% and levies transaction charges of 79p for every £100 invested, the highest of the funds listed. What's more, the fund deducts 20% of any returns in performance fees, which are set against the benchmark of the Bank of England base rate, currently at 0.5%. However, the charge is subject to a high water mark, meaning investors would only pay the performance fee if the fund's net profit exceeds its previous highest account value. Even tracker funds are not immune. THELNG Global Inflation-Linked Bond Index Fund has an OCF of 0.27%, but levies transaction fees of 0.22% on top of that, giving an actual cost of ownership of 0.49%. That may not sound like much, but it is 81.48% higher. No one's charges have actually gone up, Mike Barrett, consulting director at The Lancat, said. Investors have always been paying these fees, it's just that the fund groups now have to tell you what they are charging. Most advisors have always known there was more to fund costs than the OCF. However, in the absence of formal disclosure, this was just speculation, and they had to work with what the fund groups told them. At the other end of the scale, the Linsale Train Global Equity Fund charges just 0.01% in transaction costs, with a difference in the actual cost of ownership of just 1.33%. Similarly, the OCF of Fundsmith Equity, which topped the bestseller lists of both the Best and AJ investment platforms, is not that far off its actual cost of ownership. Woodford has disclosed the true cost of investing since April 2016. Interestingly, 7 of the 20 funds listed disclose their transaction costs as zero. However, it is unlikely these funds genuinely have no transaction costs. Instead, they could be being paid through company profits or already included within the ongoing charges cost. Investors have been frustrated for years that fuller information about costs is not available from the industry, with campaigners calling for more information. However, in a report published in July 2016, the Investment Association branded hidden fees hysteria the Loch Ness monster of investments. Indicating that the existence of harmful extra costs was mythical and hard to price. The investment industry's leading trade body claimed that fund performance over recent years is proof that costs aren't hitting returns delivered to investors. It turns out that Nessie is alive and well and charging tourists a third more for a photo than they expected, Barrett said. Now we've come this far, we also need those firms who are disclosing a zero cost to explain the basis of their assumptions. A spokesman for the Investment Association said, "The Investment Association fully supports transparency of costs and charges so customers understand what they are paying for, from the financial advisor or retail platform to the fund." This is now enshrined in law through Mifid II, as of 3 January 2018. However, the way the new methodology to calculate transaction costs was designed will confuse and mislead investors and could ultimately defeat the goal of greater transparency. This was repeatedly raised by the industry throughout the lawmaking process, with sensible alternatives proposed that would meet the criteria for greater transparency in a way that didn't confuse the end investor. Regulators must now listen to the numerous objections across the board and review this damaging methodology as soon as possible. Not everyone is entirely convinced by the comparison between ongoing charges and actual cost of ownership. Ben Yearsley, director at Shore Financial Planning, said, "The problem with these type of tables is that they show no context. To the layperson, they look bad, as they may think they are being ripped off. It would have been useful to have added portfolio turnover figures into the table, for example, which would show if the manager is active in the market." It would have been interesting to see a FTSE 100 tracker in the list for comparison purposes. What it does show is that standardized reporting is essential so that investors can see the true cost of owning a fund. Transaction costs should be disclosed, but kept separate from the ongoing management fee and other fixed costs, and reported retrospectively, as a manager won't know in advance the number of changes that will be made in a year. Investors should question the cost of investing, both from a fund perspective and platform perspective, and transparency is important. However, in my view, you should not get too obsessed as what a fund is doing and how it performs are all part of the investing process as well as cost.